With a home equity line of credit, it now puts you back in control. You dictate how much you pay in interest by utilizing 100% of your cash flow to force down the balance. A lot of folks are concerned, as they should be, about inflation. We don't know that we've hit the peak. Obviously, it's really high, highest that we've probably seen in our generation. If you're 45 or younger, with inflation at roughly 8.3%. So the question is what can you control inside of your sphere of influence to help negate inflation? And our biggest expense as consumers is probably going to be our real estate. And that's our bread and butter at Replace University, is a subsidiary called Replace Your Mortgage. Well, with Replace Your Mortgage, we show folks how to save, on average, $170,000 inside of their first year of financing differently than they otherwise would. And what I mean by financing differently, a mortgage is a very archaic tool. It was designed after 1913, at least a modern day mortgage. So prior to 1913, a mortgage used to be an open-end, almost a simple interest line of credit. So it meant that money could move in and out freely 24/7. It was especially popular with farmers. So farmers could go down to the bank the same day and say, hey, I need a $10,000 loan against my $200,000 farm. Back then, that was obviously a massive farm. But today's terms, let's just use easy numbers. So a $200,000 farm, you owe 100 grand, and you need 10 grand on top of that 100 grand that you already owe. The bank would give you a check that day and just rewrite the mortgage. So now you owe 110,000. And then you could use that 10 grand to buy equipment, farm, and then when you sell your crops, let's say for 20 grand, you go and deposit your 20 grand back into that mortgage balance. So now the mortgage becomes 90. So that generation had a couple tools that we don't use today as the average American. So that mortgage was more efficient than the mortgage that we use today. And that's why that generation, you hear of your great grandfather or grandfather saying, back in my day, our homes, we paid off in 5 to 10 years. Couple reasons for that, again, because the mortgage was a more efficient tool back then. They were a better generation. They were folks that read instead of watching TV. They didn't have TV. They didn't have social media and all these other crappy distractions today. So they just tend to be a better generation. But again, let's just go back to the financial tool. The mortgage was a more efficient tool. So what happened? Why did that change? Well, in 1913, you have the creation of the Federal Reserve. It was actually created before that, but this was the one that actually stuck, right? So in 1913, you got the Federal Reserve, and the Federal Reserve is a backstop for banks. And what they essentially do is they have one function that really changed the game for the banking and mortgage industry as a whole. They allow banks to execute what's called fractional reserve lending. So what that means is for every dollar you put in a bank account as a consumer, the bank only has to keep on reserve less than 10% of that. Sometimes, if you're a credit union, it's a 1 to 15 ratio. So for every dollar you put in a bank account, they have 10. For every 10, they have 100. You put 100 grand in, they have 1 million. So this is a pretty powerful magic trick. So after the banks got a hold of this magical trick, they got together and said, well, now we got to figure out how to increase core deposits for the banks. And they looked at how the average American was financing real estate. Where were they really storing their cash? They were storing it in a mortgage. So they made one simple adjustment. They made a mortgage a closed-end product, meaning money could go in freely, but it couldn't come out freely. So what is that going to do for you as the consumer? No different than what you're doing today. Are you going to put 100% of your nest egg and your assets into your mortgage? No, it's trapped. It's trapped in the bank's treasure chest. So what are you going to do moving forward? You're only going to put a portion of your assets and income towards your mortgage because you know it's trapped. Then you've got to leave excess funds somewhere else to operate out of, to pay bills and groceries, utilities, etc. So where are you leaving those funds? Well, in the welcoming hands of the banks, where they're going to pay you, in today's terms, 0.24%. That is your annual rate of return on a checking and savings account. National average is 0.24%. So that's how they grow core deposits, is by segregating you from your cash, from your income, by utilizing a closed-end product called a mortgage. So really what we teach is going back to basics. It's going back to the way that we used to finance things as Americans. So one of the tools that every bank has that they may not realize that they have it. They realize that they have the tool, but they don't realize how you can actually function inside of that tool. They can't prevent you from functioning this way. The only thing they can prevent you doing is from getting one. But if you qualify, they can't do that. They would break the law by disqualifying you even if you use it this way. So they can't discriminate you based on the way that you use this tool. But a HELOC is a simple interest open-end line of credit, meaning money can move in and out freely 24/7. So let's say you start out with a $300,000 line of credit and you put 20 grand in. Now your balance is 280. It recasts automatically every single day for free. So now what that means is you're paying interest on a 280 balance as opposed to a 300 balance. See, a mortgage doesn't do that. It doesn't recast automatically every single day for free. It's an amortization schedule. So you signed a death pledge or the contract, an amortization schedule that says, on month 265, when you make a payment of $1,500, here's how much is going to go towards principal, and then this is how much is going to go towards interest. So every month it's already spoken for. With a home equity line of credit, it now puts you back in control. You dictate how much you pay in interest by utilizing 100% of your cash flow to force down the balance. But the cool thing is you're 100% liquid. So anything you put in there, you have access to, again, 24/7. So you can actually pay your bills directly out of a home equity line of credit. And by doing so, you're attacking two things that are far more important than interest rate. You're attacking time and you're attacking balance. See, most Americans think that interest rate is the end-all be-all, and that's what's going to dictate how much interest you pay on any debt. That is not true. The interest rate dictates what your payment is. Time and balance dictate how much interest you actually pay. So with a simple interest open-end line of credit, utilizing 100% of your resources, you're attacking the balance much more aggressively with confidence because you have access to it. You got 100% liquidity to pay anything else. Any emergency that comes up or any bills that you have, you can pay directly out of the home equity line of credit. So that's attacking the balance. And by doing so, you speed up the payoff time frame. So our average client can pay their home off in 5 to 7 years. And that average client is saving $170,000 in otherwise what would be interest payments to a mortgage. So if you break that down over a 5-year period, that's $34,000 a year in savings. So let's say you're a 6-figure income earner, you make 100 grand a year. We're going to save you $34,000 of that 100 grand. So that's 34%, right? If you make 100 grand. Now, if it's $200,000 a year, what we're saving you 17%. Again, what were we talking about earlier? Inflation. The inflation rate is 8.3%. So yes, inflation is high, but it's not 17% high. So again, going back to how do you negate inflation and how do you fight inflation? By controlling what you can control is how you finance your real estate, which is probably going to be, again, the biggest expense that you have. It is for most folks. So if you can negate let's say you 100 grand, you got $8,000 worth of inflation, but you're saving 17 grand over here. Not only did you negate it, but you actually are gaining ground.